Hello, everyone. Good evening. How are you guys doing?
Good, sir. How are you?
I'm fine, thank you.
Good evening.
Okay. So, guys, let's start our session. Welcome to our part one. We are still in the first chapter, and last class, we were discussing about the various filing status. We started off with single and married filing jointly, and now we will start off with the married filing separately returns. So, just to do a quick recap, when do we file single status? At the end of the year, where the taxpayer is either unmarried or legally separated, divorced. Okay, that's when somebody would go for a single status. And married filing jointly comes when on the last day, the person is either married or not legally separated. Likewise, married filing separately status comes for those taxpayers who decide that they are married, but they don't want to show their income and expenses and deductions together. Then they go and file the returns individually as separately as a filing status. So married filing separately or MFS returns are filed in case the spouses agree to show them separately. Okay, this is the third status. The fourth one, the most important one, is the last two, the fourth and the fifth. That is the qualifying surviving spouse, qualifying surviving spouse. This is the fourth category. When I say qualifying surviving spouse, please remember we're talking about the spouse who is alive, meaning this status, qualifying surviving spouse, is available for 2 years after the year of death of a spouse, and may be elected if the surviving spouse did not remarry during the year and the surviving spouse qualified for married filing jointly written status for the year of the date of death or the year of death. Then the most important thing is the surviving spouse maintained a household for the tax year. So in other words, if you watch carefully, this category qualifying surviving spouse is a filing status available for those taxpayers who are married but they've lost their spouse. Remember, this is a status available only for 2 years after the year of death. For example, somebody died in 2023, then 2024 and 2025. The next 2 years only they can go for qualifying surviving spouse. It's not forever. It's only for 2 years after the year of death of the spouse. For example, the husband died in 2023, then 2024 and 2025, they can go for this qualifying spouse, surviving spouse, if they don't get remarried in the next 2 years, and what? They are maintaining a household for the entire tax year. And when I say household maintenance, it means that the surviving spouse is providing or furnishes more than half, 50% of the cost to maintain the household for the tax year. We'll talk about this in more detail, but for now, just understand that this is available only for next 2 years. That means 2024 and 2025. So what happens in the year of death 2023 when the husband is dead? What happens in that year? What is the filing status? They can go with married filing jointly. Okay, guys. So simply put, if there is a death of a person, if a person dies, husband dies or a wife dies, the surviving person, the person who's alive, for that year of death in 2023, in this example, he or she who's alive can go and file married filing jointly. Okay. Then the next 2 years, they go for this status. And this is available only if they don't get remarried. And most importantly, they are maintaining a household. When I say household maintenance, it means the surviving spouse is paying for more than 50% of the cost to maintain the household for the tax year. When I say household, it means their residence, principal place of abode, where they are living. And The very important thing is this 50% of the cost to maintain refers to maintaining the household where you have a qualifying dependent, which means that there is a child, there is a person, daughter or son or stepson, stepdaughter, adopted child. They are going to be taken care by the surviving spouse. And for that reason, they have to maintain the household for more than 50% of the cost is paid by them for the entire year. And this means the household is the place where the qualifying dependent of the surviving spouse is also using. And when I say the qualifying dependent, it means the son or daughter, stepson or stepdaughter, or adopted children. Remember, this does not include foster child. We'll talk about that, all these things in a minute, but just understand that this is the situation available only if the person is unmarried and maintaining the household of a qualifying dependent, which is son, daughter, stepson, stepdaughter, or adopted child. Okay? And there's no foster child, only adopted child, not foster child. Foster child is not included. Only if they fulfill these conditions, the surviving spouse can go for qualifying filing status for the next 2 tax years. I'll just pause for a minute. Tell me, guys, are there any questions? Did you all follow what I said? I'll give you an example, but before that, tell me, did you all follow this? Okay, the silence, I'm assuming no, everybody understood this. So let me give you an example. Let's assume there is Mr. X and Mrs. X. Mr. X died in April 2023, leaving his wife, and the wife has children, 2 children. Okay? Or rather, let's assume the wife has no children. Let's take an example where the wife has no children. So 2023, what will be the filing status? And 2024 and 2025, what will be the filing status? Tell me, guys.
2023 married jointly.
Married filing jointly. Very good.
And next year is also they can 2024 and 25 also.
So 2024 is qualifying surviving spouse.
2023, it's clear, it's married filing jointly. 24 and 25, what happens, ma'am?
So qualifying surviving spouse.
Qualifying surviving spouse, is it? Why?
So it will be as a joint because the family doesn't have any child or stepsons.
See, first year I agree. 2023, there is married filing jointly, there is no problem. 24, 25, I heard it's a qualifying surviving spouse. I'm asking you why.
Didn't remarry for the particular tax year.
She didn't get married. Wonderful. Then, does she fulfill this condition of having a household for a child? I said she doesn't have any children. Then she doesn't have any children. What do you do? Does she fulfill the second condition?
No.
Exactly. She is not fulfilling the condition. So she cannot go with married filing jointly, or she cannot go for qualifying surviving spouse, right?
Yes, married filing separately.
Not allowed, right?
Yeah.
Yes. So guys, very simple. Remember always, if anybody is remaining unmarried, then they are eligible. Okay, that's the first condition. But the condition is that they should also have a dependent child who must be taken care by you, and you must be spending more than half of their maintenance cost. You know what I mean?
Yes.
So in this case, do you think the person is eligible?
No. So they will be filing as an individual.
Yes. So what do we do in that case? Are they eligible or not?
No.
So the person has to either go with single status or anything but not qualifying surviving spouse. As simple as that. Correct?
Yes.
Yes, sir.
Simple. So I'll explain this again. The eligibility condition for this is that the person should be what? Both unmarried and must have a dependent child, qualifying child, dependent, living with you and you spending more than half the cost of maintenance for the whole year. Okay, if you don't have the second condition fulfilled, then you're not eligible for this qualifying surviving spouse. Only in the year of death, the person can go with married filing jointly, but the next 2 years, not. I would think in this case, she would be a single taxpayer. Okay. Now we go to the next most important thing, the last one, but very important one. Who's this here? Who made this? I don't know. Sometimes this happens. The green one is not going, right? You guys are able to see this green color? You're able to see green color, Mark?
Yeah.
I don't know who made it. It's not going on. I think somebody must have tried. Ah, it's gone now. Okay. Somebody's playing with my as gotten access. I don't know why. Anyways, so guys, the most important one is HOH, also known as head of household. So remember, we saw single, then we saw married filing jointly or MFJ, then we saw married filing separately MFS, then we saw qualifying surviving spouse, Then we have HOH. What does HOH stand for, or head of household? What is this for? It is a situation where you satisfy one of the following conditions. Remember, an individual qualifies for HOH if he or she satisfies conditions with respect to filing status, marital status, and household maintenance, which means there are three things that we have to be mindful. First, filing status. The individual may not file as qualifying surviving spouse, which means the person is not eligible to go with surviving spouse, qualified surviving spouse condition. That's all. Filing statuses should not be eligible for surviving spouse. That's the only thing. The second one is marital status. Guys, normally what happens in case single, you should be unmarried or legally separated, right? That's what we expect from the taxpayer. But in case of HOH, the taxpayer must be unmarried on the last day of the year, same as single. But if the person is married, it is still okay. A person married may be still qualified if the conditions under the married individuals on page 16 are satisfied. That means they are considered unmarried. What is this page 16? That is what we're going to see in a moment. It simply refers to a situation where the person is married but living separately from the spouse in the last 6 months. The last 6 months, the person is married, but last 6 months he's not living with the wife or she is not living with the husband. They're living separately for the last 6 months. Then even the married person is eligible to go with HOH status. Understood? Are you getting me?
Yes, sir.
One minute, please. See here. A married individual who lives with a dependent apart from the spouse will be considered unmarried and qualify for HOH if for the tax year, the individual files separately, the individual pays more than 50% towards maintaining the household, the spouse is not a member of the household for the last 6 months, the household is the principal home of individual's child, stepchild or foster child for more than half of the year, and the individual can claim the child as a dependent. So these are the conditions. You see, most important condition is this one where last 6 months the wife is staying away from the husband or vice versa. So if a person is married, if they can even go with the HOH status if the person can show that he is not filing jointly, that is filing separately, and he pays more than half of the cost of maintaining the household, and the wife is not living with him for the last 6 months, and he has a child or stepchild or foster child for more than half of the year living with him, and the child can be claimed by him as a dependent. In these cases, the person is eligible to go with HOH. So boys and girls, remember, what are we trying to say? We're talking about HOH status. And what is the second situation? First is the filing status is the person may not file surviving spouse status. That's all. The second one, marital status, is a situation where the person is either unmarried, or if he's married, the wife is separately staying for the last 6 months, and he's providing for the child, which is his own child or stepchild or foster child, for the last for more than half of the year, and more than half of the cost is paid by this guy. Then the person with married status can also go with HOH status. That means he's not filing joint separately, but he's going with HOH status. Clear? Okay. Then see, remember the three things. One we saw is the filing status. Then we saw marital status. Now we're going to look at the household maintenance. Household maintenance. Just like the previous case, that is qualifying surviving spouse. What did we say? That the surviving spouse should be spending more than half of the cost, 50% of the cost of the household. The similar condition is going to be seen here. That means an individual must maintain a household. That is the principal place of abode for qualifying child. To maintain the household for federal tax purposes, an individual must pay more than 50% of the cost of the household. And what does it mean? It means property tax, rent, utilities, interest, repairs, maintenance, property insurance, food, and things like that. But what is not covered is clothing, education, life insurance, transportation, medical expenses, vacations, services by the dependent, services by the taxpayer. All these are not qualifying. They are not qualifying. They are not qualifying. Okay? They're not allowed expenses. This is okay. These are allowed expenses. This is not. Clear? Which means to calculate whether the person has spent more than 50% of the cost, okay, you should check this point, whether the person has spent more than 50% for property tax or property insurance or rental, upkeep, repairs, maintenance, interest of those properties and things like that, but does not include any medical expenses, any vacation expenses, any education, any clothing, transportation, and things like that. Remember, life insurance is not allowed, but property insurance is allowed. Please remember that this is for the upkeep of the property, and this is not related to property upkeep. Clear? Am I clear with this?
Yes.
So the point is, guys, just like the previous case, that is qualifying surviving spouse. What did we learn? The surviving spouse should maintain a household, that is the principal place of abode for qualifying child, and he or she who's alive should spend more than 50% of the cost of maintenance. Same kind of a rule is applicable here also. Now the question is, who is the qualifying child? Who is the qualifying dependent? There we saw it is stepson or own child, stepchild, or adopted child, no foster child. Now let's see if the same rule applies in case of a HOH. Remember guys, this is very, very, very important. Very important. Please remember this, very, very important. Why? You're going to watch this, that the qualifying person and time. Here, it includes both a qualifying child, also qualifying relatives, which means parents are allowed, uncle, auntie, in-laws, friends. Wow. Remember, boys and girls, in case of qualifying surviving spouse, it's only son or daughter, stepson or stepdaughter, or adopted child. But in case of HOH, the qualifying person includes not only either qualifying child or qualifying relatives. Very, very important. And please keep this in mind that the taxpayer must maintain the household that constitutes a principal place of about for more than 50% of the tax year for at least one qualified individual who is a qualified child or qualifying relative. Am I clear, boys and girls? Am I clear? Please tell me. This is
Yes,
important.
sir.
Yes, sir.
All, please. I'm doing it for your sake, not for my sake. I've done this multiple times, and I've done my CPA. When I was a student, also I've studied this multiple times, guys. So 20 years ago, all these things were done. So please cooperate with me. Ask me questions if you don't understand. Okay. But one more thing I want you all to notice, this is a very crucial point. The point is that more than 50% of the tax year, which means half of the tax year, at least half of the tax year, you should have spent at least half of the cost. Remember, 50-50. 50% of the time and 50% of the cost should be paid by you. Okay, and this should be either for qualifying child or qualifying relatives. So remember, there are two special rules regarding a qualifying person. First and foremost thing is, remember, the taxpayer with a dependent parent qualifies, even if the parent does not live with the taxpayer. So what I'm trying to explain here is, if you watch carefully, it says an individual must maintain a household that is the principal place of abode for qualifying child or individual. And to maintain this, an individual must furnish more than 50% of the cost of maintaining the household. And very important thing is, it says that the qualifying child or qualifying relative must live with you for more than half of the tax year. Correct? They're saying it should be for more than half of the tax year, the qualifying child or qualifying relative should live with the taxpayer. But the exception is, in case of the parents, they do not have to live with the taxpayer. This is like an exception. The dependent father or dependent mother, they don't have to live with the taxpayer. But he has to ensure that the taxpayer is paying more than 50% of the upkeep of his dependent father or mother. I'll explain this again. In all the cases, you're going to see that the qualifying child or qualifying relatives must live with the taxpayer. That means they must live in the same house, same place where the taxpayer is living. But in case of parents, it is not necessary that they have to live with the taxpayer, which means they can either live with the taxpayer or they don't have to. It is okay if they don't live with the taxpayer. Am I clear?
Yes,
Yes,
sir.
sir.
Then, second, if the qualifying child lives with the taxpayer, the qualifying child need not be taxpayer's dependent. For example, if all regular requirements are met, but the custodial parent releases claim to the child as is dependent to the custodial, non-custodial parent. Okay, we'll talk about this later, which means if you see carefully, a qualifying child living with the taxpayer, then they need not be a dependent. See, the point is, I need somebody to live with me. And the child doesn't have to be a dependent of me. In other words, say, for example, there is a husband and wife, X and Miss. Let's assume another example, A and B, husband and wife. Okay, husband and wife got separated. Okay, if the husband and wife got separated and the baby, the child is living with the mother. Okay, okay. Now you see, the mother is having, second condition is mother is having the child with her. See here, if a qualifying child lives with the mother, that means the baby is living with the mother. Then the qualifying child need not be the taxpayer's dependent, which means the husband will be which means the understanding is between the two separated spouse, that is A and B, agree that B, wife, mother, will give up the right of showing the child as a dependent and allowing the husband to claim the child, the baby or the child, to be the husband's dependent. That is okay. So if you see this, if all requirements are met, the custodial mother releases the claim to the child as a dependent to the father. Non-custodial parent is the father. Clear? So guys, what are we trying to explain here is that if you see the condition for qualifying child or qualifying relative, more than 50% of the time they must live with you, I mean with the taxpayer. But if it is a father or a mother, they don't have to live with the taxpayer. It is okay. But in case of a qualifying child living with the taxpayer, the child doesn't have to be a dependent. It is okay. So simply put, they don't have to be a dependent. Understood? See, watch carefully. Here we said what? In case of a surviving spouse, we said qualifying dependent. We use the word dependent. Correct? In case of a surviving spouse, the child should be a dependent also. But in case of HOH, we are saying qualifying individual. The individual can be dependent or not a dependent. They can stay with you or not stay with you. Who doesn't have to stay with you? Parents only are allowed to stay without, I mean, they don't have to stay with you. Only parents are given the exceptions. But the child should live with you, uncle should live with you, auntie should live with you, father-in-law should live with you, mother-in-law should live with you, brother, sister, sister-in-law, brother-in-law, all of them that you're going to claim as relative must live with you. But they don't have to be dependent. Clear?
Yes,
Yes,
sir.
sir.
Don't worry, I'll explain all these things once again so that you all understand this. Okay, so these are the 2 points that I want everybody to remember. So boys and girls, simple, very simple. So with this, we're done with HOH. What is HOH now? HOH is a filing status available for whom? It's available for individuals who fulfill 3 conditions. Condition number 1 is the filing status. That means they are either single or unmarried or married, but wife is not living with them or husband is not living with her for the last 6 months. Plus what? He is not filing, he's filing separately, right? Plus what? He is not, see here, all these things. He is paying more than 50% of the cost of household upkeep. Plus, he is maintaining the household for child, stepchild, foster child for more than half of the year. And the individual can claim it as a dependent. If all these conditions are fulfilled, that means the first condition of filing status is taken care. Artha aita, the first one is the filing status. That means, okay, you're not filing a surviving spouse, but marital, okay, is the second one. The third category is household maintenance. What did I say? Household, what did I tell you? 50% of cost should be paid by you, and more than 50% of the time they must stay with you. 50% is stay with you. Correct? That is the third category. Okay? So if you watch carefully, we're saying qualified person is either a child or a relative. But if it is a relative, there are 2 special rules. That means relatives, parents, they don't have to live with the taxpayer. It's okay, they live away from them, but you should be paying for their survival, meaning house rental, electricity, food, and all that you should be paying. In case of a second situation, that means qualifying child living with the taxpayer, the child doesn't have to be a, remember, it's not relatives. We're talking only about the child, okay? We're talking only about the child. Only qualifying child lives with the taxpayer, but the child doesn't have to be a dependent. It's okay. But in all of the cases, they must be both dependent and must live with the taxpayer for more than 50% of the time. Now you see the beautiful summary, beautiful table. Are you ready, guys? Let's understand each of these things in more detail now. And I promise we're going to do a small revision after all this is done so that everybody's clear with the concept. Guys, the following table gives you a guide as to qualifying children and qualifying relatives. First, understand, if a person is a qualifying child, when I say child, It means son or daughter, grandchild who live with the taxpayer for more than half of the year and meet certain other tests. What are the tests? We'll see that later. For now, we're talking about qualifying child. Child means son, daughter, grandchild. And the child is, remember, the qualifying child is single or married and taxpayer can claim him or her as a dependent, or married and taxpayer cannot claim the person as a dependent. Then what happens? Guys, pay attention. We're talking about qualifying child and the child is single. In that case, then the person is a qualifying person, whether or not the taxpayer can claim the person as a dependent. You all remember, what did I tell you? If there is a child, mother and father told no, A and B, they got separated. They have a small baby. We're talking about that baby now. It's a qualifying child, single baby. Then the baby is qualified or not? Yes or no? Participate, please. Yes, right? Come on.
Yes, sir.
Yes. So what did I tell you? The qualifying child lives with taxpayer, qualifying child, and need not live with the dependent. That's what I said. Whether or not the taxpayer can claim the person as a dependent, doesn't matter whether he is able to be claimed as a dependent or not, doesn't matter, but the child is eligible as a qualifying child or qualifying person. Okay? The next situation, we're talking about same child, but the child is married and the taxpayer can claim him as a dependent, which means good. I have a child, that person is married, but I can claim that person as a dependent. In that case, okay, good, man. I can then qualify it because you know why? If they're married, remember, if single, they are eligible and they don't have to be my dependent. But if they're married, I can claim them as qualifying person only if they are my dependent. But lastly, if they're married and I cannot claim as dependent, then sorry, not a qualifying person. Clear?
Yes.
Is this
Yes.
point clear? Yes.
Yes, sir.
I'll repeat this. I'm talking about qualifying child, which means son, daughter, grandchild. Okay, grandchild also son. Okay. Now they are single, good. I don't care. They're eligible. Whether they can be claimed by me or not as a dependent, I don't care. Whether they're eligible. The second one, they're married, and I can claim them as dependent. Good. They are qualifying. They're married and I cannot claim them as dependent. Sorry, I cannot. So remember, other than the single category, to claim anybody as my qualifying person, the person should be my dependent. That's a point to be noted. You'll see that later on. We spoke about qualifying child. Now we're talking about qualifying relative, who is the father or mother, my dad, my mother. Then the taxpayer can claim him or claim my dad or my mother as a dependent, then they're qualifying person. Sorry, I cannot claim them as my dependent, then they're not qualifying. Remember, only for the child, for single status, dependency is not a requirement. But in case of other case, if they're married, they should be dependent. If they're married, not dependent, not eligible. Likewise, relative, they should be dependent. Then they're eligible. If they're married, if they're parents, but not my dependent, they're not eligible to be claimed as qualifying person. Clear? Okay.
Yes, sir.
Very important, okay? Very important. Qualifying relatives other than the father or mother, such as grandpa, grandma, brother, sister, etc., etc., etc. Then look at this. He or she live with the taxpayer for more than 50% of the year, half of the year. And he is or she is related to the taxpayer in one of the ways listed under the immediate relationships in the unit 1.4, and the taxpayer can claim the person as a dependent. So guys, important. I can claim the person as a dependent and the person is my relative and they are living with me for more than 50% of the time. Then they're eligible. So point to be noted is, I have got my brother or my sister or my sister-in-law or brother-in-law or father-in-law or uncle, auntie, okay, grandpa, grandma, okay, they can be claimed as my qualifying person if they are living with me for more than 50% of the year and they are my relatives. They should follow the category of relatives. See, girlfriends and boyfriends will not be relatives. Understand this, please. Why I'm using this word girlfriend or boyfriend? Because they are not relatives. They are not relatives. They are not immediate relationships. So even if they live with me for the full year, they are dependent on with me. Sorry, I can't claim them as a person because the condition that they should be relative. This is the one. One, live with me for more than half of the year. Okay. And third one is they are dependent. These are three situations. One, more than half of the year, they are relatives, staying, okay, they're living with me and they are my dependents, then okay. But you see, she did not live with me for more than half of the year, not eligible. She lived, but not a relative, not a qualifying person. No, or a relative and living, but not a dependent, not a qualifying person. Easy? Did you all follow this?
Yes, sir.
Yes.
Very, isn't it? It's appears to be very, very difficult, but I can promise you it's the most easiest one if you have understood this. So guys, simply put, we are talking about child. For a child, single, okay, by default, whether they are my dependents or not. This is the only place, guys, only place where dependency doesn't matter. Remember, people, this is the only category for single child, the dependency does not come into picture. They are eligible. But if they're married, they should be dependent. If they are my parents, they should be dependent. If they're my relatives, they should be my dependent. If they're not eligible, not eligible, not eligible. Clear? Artha, did you all get this
Yes,
point?
sir.
Yes,
Every-
sir.
You're comfortable with this? Okay, take a look at this example. Hector and Maria are married with one child. Hector moves out of the residence in the month of May. They are not divorced by end of the year, and Maria maintains the household for the remainder of the year and claims a child on her income tax return. Maria may claim HOH status. Why? Though she is married, she's living away from the husband for more than 6 months, and she's maintaining a household for the child for more than half of the year. And hence, Hector would be required to file MFS. Hector will go with MFS, while wife Maria will go with HOH. Artha aita, manasalayo everybody?
Yes, sir.
Yes, sir.
I'll pause for a minute. If anybody wants me to repeat anything or anybody wants me to explain this, let me know. I will be happy to do it. Or if you want me to repeat this again, tell me. I'll be more than happy to explain this again.
Sir, who is foster child?
Foster, not foster, foster. Very good question, Ma. Foster child means child who are not your child and not adopted, but they are given to you as a caretaker. See, in America, it's very common. A lot of time, kids, it's very difficult for kids, there is there will be NGOs, okay, they'll say, okay, I've got a son, I've got a boy, I've got a girl, maybe, who doesn't have parents. Can you please take care of this person for some time, maybe 1 month, 10 days, 1 week, 15 days, 6 months, and all that. They're not legally, they're not father and mother, they're not adopting the child, but they'll give shelter. Such kids are known as foster child. Okay?
Okay, thanks.
Good question, Manoj.
Sir, I have a doubt.
Tell me, Navya.
Now, like if two persons are married,
Uh-huh.
even if either one of the individuals are not earning,
Uh-huh.
so they have an option to file marriage filing jointly, am I right?
Yes.
Then how can in this example one can claim as head of the household and other can go for marriage filing separately? Can you please explain that scenario?
Wait. Good question. Why this is happening is because, Navya, your question was only about one person earning, another person not earning. Can they file marriage filing jointly? The answer is yes. But the example here is husband and wife, they both are married with a child. But problem is they both are now living separately. Are you getting it?
Yes.
If they don't like each other, they can go with MFS. But the rule says Maria still has a choice to go with HOH if she can show that there is a child that she's taking care of for more than half of the year and she's maintaining a household for the more than half of the year. In that case, she's eligible to have this filing status known as HOH. But the husband, Hector, will still go with married filing separately. Why? Because he's not legally separated. He cannot go with single status. He can't go with MFJ because Maria doesn't want to do it. He can't go with qualifying surviving spouse because Maria is still alive. He can go with HOH? No, he cannot, because he doesn't have anybody to take care of. But assuming Hector is also living separately and he has a father or mother to take care, then he can also go with HOH.
Okay, sir, got it.
Good question. Yeah, I like the questions. Anybody else, guys? No, everybody's so thorough, huh? Oh my gosh, I love the spirit. Let me ask a question if that's the case. Guys, tell me what is the answer to this situation. Okay? 2022, Mr. Bond, James Bond, in a New Year party falls in love with his girlfriend and they get married on 31st of December 2022. In 2023, they are blessed with a beautiful baby and they have a happy life. 2024, there is a misunderstanding. And Bond says, I found another girlfriend. I'm going to go away from you early in February itself. But Mrs. Bond, applying for divorce, still hasn't got it by end of the year. She is taking care of the baby. And 2025, James Bond in an investigation gets killed and is dead. Tell me, what is the filing status for 2022, 2023, 2024, and 2025? Down, 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 down.
2022, it's married filing jointly.
Or married filing separately. Remember, you cannot always conclude it has to be only MFJ. It has to be, it can be either MFS or MFJ. Okay,
Okay.
good.
And 2023, again, it's same. KMFS or
MFJ. Okay.
24, it can be like
James Bond has found another girlfriend, so he's leaving his wife in February and left her, and she's all alone taking care of the baby, beautiful baby.
Will
Sir,
be
for
MFS.
It can be HOH.
HOH.
Who can take HOH? James Bond, because he's taking
Um,
that
Wife.
The one who was taking care of that child.
is James Bond, no, Mrs. James Bond. What happened to Mr. James Bond then?
He dies. Sorry, she dies.
No, no, why are you killing her? In 2024, they both. But husband has found another girlfriend, moves out of the family.
She'll apply for head of house.
Wife will apply for HOH because she's taking care of the baby for more than half of the year. Okay, good.
and the last year, 2000.
Wait, what happened to James Bond? What filing status he'll get?
Die.
Huh?
MFS.
2020.
Or
Exactly. And in 2025,
Mrs. Bond will file as qualifying surviving spouse.
Manoj, 2025 is when James Bond dies. So that year she cannot go with surviving spouse. She can apply that only in 2026 and 2027, next 2 years.
Got it. Yeah.
That year she can go with fighting giantly. She's taking a revenge now. Man, I'm the one who sent a spy to kill you, buddy. Now I'm going to enjoy all your wealth and I'm going to be filing MFJ. Right? She can go with MFJ, remember, okay?
Yeah.
But 2026 and 2027, can she go with qualifying surviving spouse?
Yes, sir.
Yeah.
Why?
Because
Because she has a dependent child.
Let's assume in 2026, she, to take revenge of the Bond's girlfriend, okay, she marries girlfriend's husband in 2026. What is the filing status?
will be
married
M-
filing jointly.
joint.
Jointly or separately, right? Are you getting me? Right?
Yes.
Yes,
The
sir.
fun of all this, but actually, this is all possibilities, right? Remember, she must remain unmarried for next 2 years. Only if she's unmarried, she can get that qualifying surviving spouse. Otherwise, she's going to lose it and go with MFS or MFJ. And to get that qualifying surviving spouse, she has to also have a child who's living with them for the whole year, or no, and she's taking care of the cost. At least 50% of the cost should come from her. So yeah, everybody follow this?
Yes, sir.
Awesome, guys.
Yes, sir.
Cool. With that, we're done with our first category, which is the filing status. Everybody's comfortable with this filing status, right? Now we go with the filing requirements. And this is a case where we are going to understand who must file the return. Give me 1 second, please. Oh, wow, very interesting. Muruga. Okay. Oh, okay. Guys, this next module that we are going to cover now will talk about the filing requirements, which means when do you have to file the return? What triggers the filing requirements? When should an individual file the return? The answer is very, very easy and simple, that if the gross income is above a threshold, that means the net profit or net earnings from self-employment is $400 or more, or she is or he is a dependent that is listed on another person's tax return with a gross income, okay, with more gross income than standard deductions, or with unearned income over $1,300. So please remember, you have to ask your client to file the return if they are having a business and the net profit from business self-employment is $400 or more, or he or she is a dependent that is listed on another person's tax return. She's a dependent with more gross income than standard deductions, or with unearned income of over $1,300. So if any one of these apply, you have to remember to file the tax return. Clear?
Yes, sir.
Yes.
So I'll repeat this. First one is if your net profit is more than $400 or more, or if you're a dependent and your income is gross income is more than the standard deduction or unearned income of over 1,300. What is unearned income? Unearned income means income that you're not earning, like interest, dividends, capital gains, okay, royalty. All these are unearned income. Okay, if it is more than $1,300, then you have to file the return. Now, standard deduction is a very, 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 very important topic. So remember, the standard deduction is what we are going to be learning. And there, I'll explain that there is a choice to go with itemized deduction and all that in a minute. Okay, taxable income is, TI is adjusted gross income, that is AGI, minus the higher of standard deductions or itemized deductions, and then minus the QBID. Oh my God, this looks very complex. No, I'll help you all. Give me a minute. First comes gross income. Guys, remember, first comes gross income. From there, reduce what we are going to be learning later as adjustments. From the gross income, reduce the adjustments, and what you get is the adjusted gross income. Then from the adjusted gross income, the taxpayer can go with standard deductions or itemized deductions, whichever is higher, standard deductions or this one, whichever is higher. Okay, you can take whichever is bigger, higher. Then minus QBID, that is qualified business income deduction. What you get out of this is the taxable income. Write down if you want. See, gross income minus adjustments, you get adjusted gross income. From there, minus standard deductions or itemized deductions. Then from there, minus QBID. Then what you get is the taxable income. Now read this and read this, then you understand what I'm saying. Tell me once you have read this and tell me if you have understood this. Artha aita, did you follow the statement? Taxable income is now what? AGI, adjusted gross income, minus higher of, that is, which is higher? Itemized deductions or standard deductions, then minus QBID gives you taxable income. Correct? Did you follow this? Same thing, right?
Yes, sir.
I'm assuming everybody got this, okay? And remember, this is a choice. That means you can go with standard deductions or itemized deductions. This is a choice given to the taxpayer, and this is a choice that you can have every year. In 2020, for example, you went with itemized deduction. 2021, again, you went with itemized deduction. 2022, you can go with standard deduction. Then 2023, you can go with itemized deduction, which if that is beneficial, if the amount of money that you're going to get as deduction is bigger or higher, then go with the one that is beneficial. Okay, that is what we are trying to explain here. And remember, that can be changed every year. There's no problem. Now comes ineligible. Please put a star to this. Who is not eligible for standard deductions? Remember, underline, the following people are not allowed the standard deductions. That means obviously people who itemize. For example, if I'm going to do itemization of deductions, then I don't have to go with, I cannot go with standard deduction. Either this or this. Only one I can take. So that's what they're trying to explain again, that a person cannot get standard deduction and itemized deduction together. Then non-resident alien individuals not eligible. Non-residents are not eligible for standard deductions. Then individuals who file a short period return not available, not eligible. When I say short period return, it means they are going to file only for 3 months, 7 months. Okay, only for that period they file, then they are not eligible. Then a person, married individual who files separately and spouse itemizes, which means when husband and wife are filing separate returns, MFS, one cannot go with itemized deduction, another cannot go with standard deduction, which means both should claim standard deduction or both should claim itemized deductions, which means they cannot choose. They cannot say, I don't care about my wife, I'll go with itemized deduction. If I am itemizing, my wife should also itemize in a separate return. Okay, that's very important. Then this is not available for partnership firms, estates, and trusts, and for corporations. Okay, this is only for individuals, by the way. This is only for individuals, so this is obviously not available for companies, estates, trusts, and partnerships. So remember two things. One, non-residents not available, not eligible. Short period not available, eligible. Married filing separately, not eligible. If both, and that means both should go with standard deduction or both which should go to itemized deduction. They cannot choose separately one item each. Then it's not available for companies, corporations, estate, trusts, and partnerships. Look at this example. Gary and Sarah Bears are married but filed separately. Gary has AGI of 40,000 and $8,200 of itemized deductions. Sarah has $30,000 of AGI and $17,000 of itemized deductions. Tell me, guys, if they both were not married, they're filing separately, obviously, what you would have said, Gary go with standard deduction and Sarah go with itemized deduction. But because they both are married and they're filing separately, both should either go with itemized deduction or they should go with standard deduction. Look at this. Gary and Sarah can take the standard deduction of $14,600 each. If they do itemization, then the amount they would get is 8,200 and 17,000, which is 25,000, which is okay lesser than 28 or 29,200. If either of them choose itemization, then the other is also required to itemize. So simply put, both should either go with standard deduction or they should go with itemization. One cannot choose itemization, other cannot use standard deductions. Okay, if you all understood, we'll quickly move to the next topic, which is standard deduction. What is the amount of standard deductions? I'll just quickly check the standard deduction amount. Standard deduction. For tax year 2025 in the USA. See, Guys, the amount is now for 2025 increased to 15,750. Okay. Just come here, write down this, guys. 15,750 for both married filing separately and jointly. It is 15,050, and married filing jointly is 31,500 and 23,625. Guys, this is the revised amount, okay? Whatever numbers that you see is for 2024, but 2025, the amount got updated. So, okay, just that's what I'm trying to update. When you get a new book, textbook, you'll see all these things printed correctly. But for now, I'm using 2024. So, boys and girls, what I'm trying to explain here is, keep in mind that for 2025, the standard deduction amount will be for single and married filing separately, 15,750. Okay. 2 times of that is for married filing jointly and qualifying surviving spouse. See, 15,050 into 2. 15,050 into 2. While this will be, HOH will be 1.5 times. This is 1 time. This will be 1.5 times. And this will be 2 times. For example, check 15,050 into 2 is 31,500. Into 1.5 times is HOH, 23,625. Correct? Married filing jointly and qualifying surviving spouse will get 2 times of standard deduction for a single and married filing separately. And in case HOH, they'll get 1.5 times of the single amount of 15,750. I'll pause now. Tell me, did you all follow this?
Yes.
So what is additional?
I'll come to that. Write down that, please. Yeah. So guys, if you watch carefully, the basic amount has got changed. That has become 15,750 for single and married filing separately, while married filing jointly and surviving qualifying spouse is getting 31,500, while HOH gets that 21,900. Okay. Now, for additional category, the amount is changed to 1,600 for married filing separately and 2,000. Okay, this is all. I'll just rub this for a moment. This is 1,600, right? Yeah. It's 2,000, 2,000. Guys, write down. This additional amount is from 1,550, it has increased to 1,600, and 1,950 has become 2,000. Okay, write down this. I'll explain all these things in a second, in a moment. Hope you all wrote this, okay? Now, guys, what does this mean? It means that if anybody doesn't, if a taxpayer wants to simply claim an amount of standard deduction, the amount will be like this. Depending on the filing status, it's going to be like this. But in addition to that, they get something known as additional standard deductions. And what is this additional standard deduction? This is available in case of a taxpayer who is 65 years or above or is blind. Then they are eligible for additional amount of deductions. So guys, you're like senior citizens, okay? Senior citizens, okay? They get this. But if a person is both senior citizen and is blind, then they get 2 times the amount. Please remember this. If a person is 65 years or above, okay, or is blind, they get this additional amount depending on the filing status. But if they are both blind and senior citizen, the amount becomes 2 times this amount. Understood?
Yes, sir.
Yes. So now the question, I want you all to also remember something important. Look at this. The basic standard deduction amount depends on the filing status and the dependency status on another's return. The table below, okay, we saw. Look at this. The basic standard deduction amount for a child under 19 years of age or a student under 24 years of age who can be claimed as a dependent on another person's tax return is limited to the greater of $1,300 or earned income for the year plus 450 plus 15,750. Okay, so I'll repeat this. What I'm trying to tell you is the standard deduction, the basic standard deduction amount for a child below 19 years, or if a student 24 years or below, who can be claimed as a dependent on another person's income tax return is higher of 1,300 or earned income plus 450 plus 15,750. 15,750. Okay, this is for in case somebody can be claimed as a dependent. So in other words, guys, simply put, remember the standard deduction amount is this, and if a person is blind, he gets this more. I'll give you an example and tell me who can answer this. Let's assume there is a person, Mr. X. He is unmarried and falls under single category. He is 67 years old. What will be his standard? Let's assume he's 27 years old. What will be the filing status? Sorry, what will be the standard deduction he'll get? He's 27 years of age. He's single status. What is the amount of the standard deduction he'll get?
15,750.
15,750.
Perfect, yes. But what if he's blind? He'll get how much totally?
17,750.
Yes, 15,050 plus 2,000 he'll get. Excellent. What if he's married, filing jointly, and he is 27 and blind? Only he is blind. He is filing MFJ and he is blind. His wife is not, only he is blind, and he is 27 years of age. In that case, standard deduction will be 31,500 plus $1,600. But if, let's assume both husband and wife are 66 years of age, they are married filing jointly. What is the amount of standard deduction they'll get? 31,000 plus into 2, right? Remember, standard deduction is 31,500 plus, because they are 66 years of age, both husband and wife, 1,600 plus 1,600, they'll get 3,200 additional. Are you getting it? Which means 1,600 into 2 plus 31,500 is 34,700. Clear?
Yes, sir.
Yes, sir.
Everyone? Yes.
Yes, sir.
One more situation. Let's assume you are going to have a taxpayer who is 61 years old, while the spouse is 67 years old. Okay, husband. Okay, husband. And there's a wife, and she's blind. What is the amount you get?
For blind, we will get this twice the amount. For this husband, we'll get only that senior one additional amount. That is
31,500 is what they're getting. Okay.
Plus 1,600.
For whom?
For husband.
and 1,600 for wife to be blind. Because for blind, age is not a factor. Remember, age is not a factor, so you should add it. See, understand what is this additional amount? Additional amount is given for those who are either blind or 65 years or above. In this case, she is blind, 61 years and blind, so she's eligible. And husband is also eligible because husband is above 65 years of age. So they are eligible for 1,600, 1,600. Clear?
Okay, got.
Clear? Yeah. Chalo guys, look at this example, beautiful example. Tony Mills, 52 years as HOH, qualifies as HOH. What will be the basic standard deduction? Here it is. As per this, it has to be 23,625. Correct? That's what it should be. The amount is wrong, but the textbook should be updated. But he gets a standard deduction of 23,625. Okay. Next one. Mike Forth is 68, legally blind, and qualifies as HOH. What will be the standard deduction? The standard amount of 21,900, that's the old one, but you'll get 23,625 plus he also qualifies for two additional standard deduction. That is for being old and blind. So how much you get? 2,000 plus 2,000. Correct? Are you getting it, guys?
Yes, yes.
See, this guy is
Yes.
68 years, so senior citizen plus blind. So you get additional amount for this, you get additional amount for this. So in this case, you get standard deduction plus additional amount will be 2,000 plus 2,000, 4,000 will get added. Okay, because it's HOH. Clear, guys?
Yes, sir.
Okay, that's what is given here. Last one. Johnny Woodson is unmarried and fully supports a 72 years old mother. Johnny qualifies as HOH. The basic standard deduction is 23,000. Okay, 15,050 into 15,750 into 1.5 is 23,625. He may not claim standard deduction for her mother. Why he cannot claim the standard deduction for her mother? Though she is 72 years, blah, blah, because she's a dependent. She's not a taxpayer. Are you getting it? Guys, see, son is taking care of mother who's 72 years age. Correct? And he's eligible for HOH. If he's eligible for HOH, the amount that he's eligible for is 23,625 he'll get. Correct? But will he get any standard deduction, additional standard deduction? Will he get any additional standard deduction?
No,
No. Why?
because his mother is having senior citizen, not the son is not a senior citizen, right?
Yeah. So he's not eligible to get that.
Yes.
Okay. Okay, guys. I think we'll stop the session for now. We'll take a quick break. It's about 7:15. We'll come back at 7:25. Is that okay?
Okay, sir.
Yeah. See you guys at 7:25. Bye-bye, guys. Okay, guys, you back?
Yes, sir.
Awesome. Give me a moment, please. Okay. So, guys, just to repeat, we were just talking about standard deductions, and we know that the individuals can go with the standard deduction based on their filing status. And if the taxpayer is either blind or senior citizen or both, the amount can get added as standard deduction. So 2025, the amount is going to be these. Now we saw some examples. Now look at the gross income filing threshold. That means until 2026, that means including this year, 2026, the gross income threshold, filing threshold amount generally is the standard deduction, excluding any amount for being blind. What does it mean? It says, if you remember when I started this module, I told you who has to file the returns, right? So the answer that for that question is yeah. For up to this year, 2026, the taxpayer whose income is more than the standard deduction. Remember, we're not talking about the additional standard deduction, only the standard deduction of 15,750 or 2 times of that or 1.5 times of that is the cap. If the income is more than that amount, then the person is required to file the return. So remember to underline this. Until the year 2026, the gross income filing threshold amount generally is the standard deductions, excluding any amount for being blind. The except, remember, it's only blind, which means senior citizen allowed, okay? For first exceptions to the general rule is $5 filing threshold for married filing separately. Remember, this is a general rule. That means if your income is less than the standard deduction, you don't have to file. But in case the person is going with MFS, even if the person is having an income of $5 or more, then they are expected to file the return. That's the first exception. The second exception is that, except for MFS, the filing requirement limitations are increased for taxpayers by additional standard deductions for being over 65 and not being blind. That's okay. That's what I emphasize on this, which means if a taxpayer is of 65 years or above 65 years of age, there is an additional standard deduction of 1,600 or 2,000 that's get added, right? They're saying if the taxpayer is a senior citizen that is more than 65 years of age, then the standard deduction amount, whatever you have, please consider even the additional standard deductions for arriving at the answer whether the taxpayer needs to file the returns or not. Okay, so only thing I want you all to remember is if somebody is going with MFS, $5 is a threshold. If your income is more than $5, they should file it. That means eventually everybody will file it. But in case of other than that, the standard deduction amount should be the base, excluding the additional amount for blind. But if you're a senior citizen, there is an additional amount for senior citizenship, it's added, not a problem. And very, very important thing is this. If you see, gross income does not include any social security benefits unless the taxpayer is married, filing separately, return, and live with the spouse at the time during the year, or half of the social security benefits plus other gross income, and any tax exempted income is more than $25,000 or $32,000 if MFJ. Guys, these amounts may change because this is for 2024. 2025, the numbers may change. But for now, just remember the concept. Understand the concept. What does it say is if the gross income should not consider any social security benefits. But this should be added if the taxpayer is going with MFS filing status and has lived with the spouse for the whole year. Or at any time, not only at any point in time during the, at any time, even for a single day, she had lived with the husband. If married filing separately, consider the social benefits also. Or half of the social security benefits plus gross income and any tax exempt income interest is more than either $25,000 or $32,000 as the case may be. If this is the case, then you should consider a gross income with the social security. Please understand step by step. First, you have to arrive at the gross income. How do you get the gross income? Gross income is all your income. That is what we are going to be learning from next chapter. Okay. And for the purpose of calculating when do you have to file the return, your gross income should be more than $5 in case of MFS, but in case of other than MFS, it should be more than the standard deductions. But if it is a senior citizen, include the additional standard deduction also. But what is gross income? It means all your income. So it does not include any social security benefits. But please include the social security benefits in case of MFS and the spouse lived at any time with the husband or wife, or half of the social security benefits plus gross income plus any tax exempt interest income. All that put together is more than this threshold amount. Then your gross income should be considering the social security benefits also. I'll pause for a second. Tell me, guys, did you understand what I'm trying to explain on the note part? Okay. One more thing is, again, the second exemption is repeated here. Each individual who is over 65 is entitled to an additional standard deduction when calculating the gross income threshold. That's, again, second exception that is getting re-emphasized here. Okay. Now, another thing, any personal residence disposition gain that was excluded and any foreign earned income that was excluded must be added back to gross income for finding out the filing requirements. Guys, very, very important point. So if you see this paragraph, what are they trying to say is, if there was any foreign earned income that is excluded, that means that's not taxable. Plus, if there was any property that was sold and not taxable, please include those items also for arriving at the total amount of gross income to check whether it is above your standard deductions or not. So simply put, only for the purpose of finding out the filing requirements, include even the exempted items. Did you follow what I said now? Did everybody understand what I said? Guys, this is a very important point. For the purpose of finding out whether you are required to file the income tax returns or not, even the exempted income from foreign earned income that is not taxable and any personal property that is sold that is not taxable that income should be added to arrive at the gross income to see whether it is beyond the threshold of 15,750 or not. If it is exceeding 15,750, then you have to file the return and you don't pay taxes anyways. You have to just report it. That is what they're trying to explain. Let's take an example here. If it is not giving that example, then I'll explain again with my own example. Josie is retired and receives only $2,500 in the form of interest income for the year. She sold a property which she has lived in for over 10 long years for $180,000 with a gain of $40,000. Guys, I'm going to pause now. Remember, she's getting only $2,500 of interest income. And she has sold a personal property for a profit of 40,000. And this is not taxable. Remember, this is a gain, residence income, property sold is not taxable. It's excluded. Please tell me, should she still file the return or not? Remember, only 2,500 is taxable. $40,000 is not taxable. And this amount is below standard deduction of 15,750. Should Josie file it or not? Answer, Madi, please.
Sir, can you explain it? Can you please repeat the
I
explanation?
will not. It's clearly printed. I can't repeat it. You have to answer this.
I think so.
I'll explain that later, Nabila. Just read the question.
She'll report it and she'll file for return.
Very good. Very good. So I'll repeat the question. I'll repeat the answer, Navya. I'll explain the concept and repeat it, Navya. It's very clear. I've told you multiple times. I can't keep doing spoon feeding. Then I keep doing the same thing 1,000 times. Guys, understand this question. Here the question is, this person is selling the property for $40,000 of gain. Is it taxable? Not taxable. This is exempted. They are excluded. And what is taxable is only $2,500 of interest income. The question is, should she file the return? The answer is, we have to check whether, what is the conclusion? How do you identify whether a person should file the return or not? Simply check the gross income. Is this more than standard deduction? Then file the return. Correct? Kavya or Navya, sorry. Navya.
Yes, I got it.
Okay. Now, what is a gross income? Gross income is only $2,500. Correct? So this is below 15,750. Correct? So should she file the return? No. Correct? Do you agree? Forget about the second part. This is below this, so she doesn't have to file the return. Do you all agree with this point? But why only 2,500 is taxable? Because 240,000 is excluded, is not taxable. But the law says, please consider the personal residence disposition gain that was excluded and foreign earned income that was excluded must be added back to gross income to find out the filing requirements. So they're saying, though this is not taxable, please add that back to this amount. So now you see it is 42,500 and this is definitely more than 15,750. So she must file the tax return. Understood? Navya, did you follow? Did everybody get this?
Yes, sir.
Yes. So the point is, though 40,000 is not taxable, is not your gross income, please add it just to find out the definition of gross income for finding out whether filing of your return is required or not. And given that scenario, you have to file the return because 40 plus 2,500 is this 42,500. But eventually she won't pay any taxes. Remember, she will not pay any tax because her income is only 2,500. 40,000 is not taxable. Plus a standard deduction will be 15,750, which means no income only, nil. Taxable income will be nil. Correct? So she won't pay any taxes. That's different. But for filing the return, you have to consider these two items. Okay, guys? This is very, very important. So I'll give you one more scenario. Let's see who's a smart kid now. I've given all this. I want you all to please answer this. Guys, tell me, you are having a total gross income of $7,000 interest income. $7,000 of interest income. Okay? $7,000 is the interest income that you are having. That's all. Should you file the return or not file the return? That's all. Chef
No.
Stephen,
No,
no.
sir.
No.
Why? Because that's below, the gross income is below the standard deduction.
Standard deduction.
Let's assume this amount is increased to 17,000.
We need to file.
We need to file.
Wait. I love the answers. I love your spirit, guys. Just give me 1 second. Let's assume the income is 17,000 interest income only, nothing else, and the age is 69 years. Should you file it or not?
No.
Who said no?
No.
Why?
The standard deductions is 15,000 plus the additional deduction is 2,000.
2,000 or 1,500? 1,900. $1,600, no?
1,600.
So
1,600 here.
So 15,050 plus 1,600 is 17,350. Again, file it or not? Don't file.
No.
No. Very good. Guys, let's take the same scenario, 17,000. But the person age is 29 years old and blind. Should you file or not?
No.
Who said no?
Blind because
Wait. No. You should not file, right, Manoj? Yes. Manoj, you agree?
yeah. No filing.
Answer is wrong. Whoever said no is wrong. What did I tell you all? What did I tell you all? You're not focusing, man. The gross income threshold amount generally standard deduction excluding any amount for blind. Only for senior citizen, you can add the additional deductions, not for blind. So the threshold is 15,750. This amount is more than 15,750. So this person should file or not file the return?
File.
Should file
The return. Guys, pay attention, okay? Very important. Now, one more scenario. The income is say $2,000 of interest income in the US. Then there is a foreign earned income that is excluded, not taxable, which is $21,000. Tell me, should the person file the return or not?
He should file the
Yes.
File the return.
Why? Why?
He have
Because of this reason. Any
foreign
foreign earned income that is
earned
excluded.
income
Correct.
must be added.
Should be added. So the amount becomes 23,000 and the filing status is single. Then it's much more than 15,750. So they should file the return. But ultimately they won't pay taxes. But still they have to file the return. Very good. Did everybody get this? Navya, Purchidama, Navya, did you follow?
Yes, sir.
Everybody got it?
Yes, sir.
Yes, sir.
Awesome, guys. Awesome. I love this. Now, I want you all to notice something. Special conditions may also require filing. That is okay. But very, very important is this one underline. Even if not required to file, if you have any refunds, then you have to file it so that you can get the money back from the IRS. Even if you don't have to file, you still have to file the return if there is any refund of taxes. Now comes the statutory requirement. Guys, remember, we are talking about so many things. We spoke about the standard deductions, additional standard deduction, then filing requirements. Then we are talking about the signature requirements. That means who needs to sign the return? Obviously, the taxpayer. But in case of married filing jointly, both should sign, but one can authorize the other person to sign. Okay, underline. The taxpayer, the spouse, and the paid return preparer. All three, okay? Three. All must sign the completed return, declaring under the penalty of perjury that they have examined the return and the accompanying schedules and statements, and to the best of their knowledge and believe the return schedules are true, correct, and complete. Which means the document should, when you're filing the return, you should sign it. Your wife should sign it, and the tax return preparer should also sign it. That's all. As simple as that. Everybody under the statement that you are, to the best of your knowledge and believe, if that is complete. Okay. Then comes due date. We all know what is the due date for filing the individual tax return. Answer, Madi.
15th day of 4th month.
Correct. It's April 15th in short for calendar tax year. But if it is Saturday, Sunday or legal holidays, the next working day becomes the due date. And very important is there is an automatic extension of 6 months provided if you file the form 4868. Remember, this is only an extension for, guys, remember, if you file this 4868, there is a 6 months of automatic extension given to the taxpayers, which means you don't have to wait for the approval from the IRS. Moment you file 4868, before 15th April, you get up to October 15th. But this is an extension approval only for filing, not for payment of taxes. Very, 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 very important. People don't get confused. Many students make this mistake. The extension approval is only for filing, not for payment of taxes. Clear? Put a star to this. Very important. You get 6 months of automatic extension for filing, not for payment. But if you are a US citizen or resident who is on a military duty or naval duty outside the US or Puerto Rico or okay, on 15th of April, then you don't have to file anything. You get automatically 2 months of time extensions without filing this. So if you're in the military duty, army duty or naval duty and things like that, and you're outside of the US on 15th of April, then 2 months of automatic extensions given and you don't have to file anything. Then later, if you want, you can file this form 4868 and get 4 months of additional extension after 2 months of extension. Then in case of a person who dies, today I was doing a session on part 2. And remember, I think Manoj, you were there right in the beginning. And you see, it is important that if in case of a deceased person also, the person who dies, he also should file the return. Of course, he doesn't have to come down to the earth and sign the return, but somebody will do it. And that return should also be filed by the 15th of April. Then
Yes.
there is also a form known as 1040 NR. That's NR stands for non-resident aliens tax return. Remember, there's a return called 1040 NR. That is for non-resident aliens tax return. Okay, they must be filed within 15th day of the 6th month after the close of the tax year. Remember, it's a 6th month. That means June 15th. June 15th for non-resident aliens. Then a non-resident alien must file his or her return on the 15th day of the 4th month after the close of the tax year if his wages are subject to withholding tax. Remember, the due date is same, that is 15th of April, if there is any taxes withheld from the salaries. But if there was no tax withholding, then you get time till June 15th. Okay? Any questions? I really want to finish this. Yeah, we should. Okay, I'll just pause now, guys. I don't think we should be doing this penalty. Okay, we'll try to complete this. Guys, the next thing is liability payments. The tax liability must be paid when the return was filed. I told you, right? The extension is not for payment. It is only for filing. If you don't pay the taxes on time, the interest is charged from the original due date. Interest will be charged. And there is a penalty of 5% per month up to 25% of unpaid liability if you're not filed the returns. Remember, you're not filing the return on time and you're not paying the tax on time, then there is a 5% penalty each month. But maximum liability will be 25% of the total unpaid taxes. Then, in general, a failure to pay penalty is imposed from the due date for taxes. Okay. And penalty is 0.5% per month of taxes not paid up to 25%. Then failure to pay penalty may be offset for a failure to file penalty. Remember the two parts. One is called failure to pay penalty, which means you are not paying the taxes on time, then you pay this penalty. But there is also something known as failure to file penalty, which means you are not filing it on the due date. Then there is a penalty of 0.5%. Okay, that is what they're trying to explain. Then record keeping, guys, very, very important. Record keeping is important. Books and accounts and records sufficient to show the details of income, deductions, expenses, credits, etc., must be kept. Okay, as long as the contents may be material in the administration of any law. Then employers are required to keep the records of at least 4 years after the due date of the return or payment of taxes, whichever is longer. Remember, all these should be maintained for 4 long years in case of employers. That means I'm your boss, I'm your company, I'm your employer. Any salary I pay, any taxes I'm withholding, any social security tax I pay, all that should be maintained for 4 long years from the date of payment or the due date, whichever is later. Okay. Then EIN, that means employee identification number. If an individual is required to report employment taxes, then he must have an EIN. That means it is a 9-digit number. The IRS will give it to me for records of tax accounts of the employers. Okay, I need to get this EIN if I have employees, and that is a 9-digit number that I get from the IRS. Okay, then comes penalties for the employers. Guys, pay attention. Penalties are applied when employer fails to pay the taxes on time. See, you all get salary. I'm catching the taxes, withholding taxes, and that tax should be paid to the government on time. But if I don't pay the taxes on time, there will be penalties. The amount of penalty will be 2% for deposits made 1 to 5 days late, 5% for 6 to 15 days late, and 10% for 16 days or more. Remember, this is a very big amount of penalty that I have to pay. Okay, there are some exceptions for 15%. That's okay. This is beyond the scope of the exam. So remember, as employers, whatever taxes that are withheld and not paid on time to the government, there will be penalty of 2, 5, and 10% for every period of delays. Then we have IP PIN. IP PIN stands for Identity Protection Personal Identification Number. Don't worry, this IP PIN is discussed at length in your part 3 representation chapter. But anyways, what is this IP PIN or identity protection PIN? It is a 6-digit number given to eligible taxpayers. Why it is given to them? Because they want to protect some frauds happening in the income tax returns. Some people misusing the income tax data like social security numbers, income bank details, and file fraudulent tax returns and get the money from the IRS. So in order to stop such frauds from happening, in order to stop any malpractices and so on and so forth, the IP PIN was introduced, which was given to not all, to some eligible taxpayers. And you can also apply if you want. And that is a six PIN. It's like a PIN code, guys. And this is given to protect the taxpayers, and their data is going to be protected from any frauds and things like that. Now, if a return is e-filed with the social security number and incorrect PIN is made, the IRS system will reject the return until the correct PIN is entered. If the same conditions occur on paper file returns, IRS will delay the return processing and any refunds. Okay, because they know that something is wrong because PIN is not correctly entered, refund will be withheld by the IRS. So guys, with this, we're done with our chapter 1.3 module. Wow, man, this is very important. Dependents are very, very important. Here we learn about qualifying child, qualifying relatives and all that. Then we have unearned income of the dependents. Then we have non-residents and dual status. Oh my God, it's quite a big chapter, dude. I hope that's done. Yeah. It's a big chapter, but it's worth it, okay? A lot of things you're going to learn. And this is all very exciting, honestly. The beginning, all this looks big, but it's quite an impressive, contents. And I'm sure you all will learn and enjoy this. So guys, with this, I'm going to pause and stop the session for the day. It's I just 5 minutes early I'm going to give you. But any questions you got, please tell me now. We'll use the time now to go through any topic that is not clear, anything that you want me to repeat and all that. But by the way, are you guys learning something? Are you enjoying the sessions?
Yes, sir.
You guys are learning something?
Yes, sir.
Yes, sir.
Good. So you're confident of whatever topics that we've covered so far?
Yes, sir.
Thank you, ma. Okay. Chalo, guys. Any questions? Anybody has any questions, any doubts, anything that they want me to repeat or explain?
Sir, in the table for qualifying children and relatives, there was some other tests that the taxpayer should meet. Can you tell me about that test?
That is for tomorrow, ma. That is for tomorrow because that is all will be discussed in the dependence category. You see, the next chapter, next module that we have, no, that's where we're going to talk about all this test dependents, who are dependents, who is a qualifying child, what should be the age, all that residential status, can they be married? If they're married, can they be claimed as dependent? All that will be discussed here, ma.
Okay, sir.
Good. That shows that you guys are focusing, huh? That shows that you guys are listening to all this. Okay. Anything else?
Excuse me, sir.
Yes. Tell me, Navya.
Sir, as you have changed some figures and you told that the textbook is yet to be updated, I just want to ask a doubt that on which year tax laws that we will be
2025.
tested.
2025, ma.
Okay, so this year this year if you want to write the exam, so we'll be tested on 2025 tax laws.
Correct, ma. Time up. You have to wait for 2025 is what will be used.
Oh, okay, sir. So in the month of March and April, we will not be allowed to write our exams.
March and April, yes, ma. It's only it's out of 12 months, 2 months is not allowed because the IRS will be updating the contents and all that. And
Okay.
from April, it'll be opened.
Okay. So is this information true that we'll be having remote
Yes.
remote session to attend exams?
Yes, yes, yes.
Okay, sir. Thank you.
Thank you.
From April onwards, the addition will be like 26 additions, sir. What we are referring is 25 addition.
What you're seeing is 2024 textbook now. This is 2024. The syllabus will be of 2025, last year. Tax rules will be applied.
The books we have received is 24-25 additions, sir. It
Yes,
says
ma'am.
applicable till February 28, 26. So if you have writing exam in
That's
the
what I'm
month of
telling
May,
you. February 2026 is over.
okay,
You cannot write exams. You're still a student. Another 15 days, if you can go write the exam, then this is whatever you're seeing is still eligible, still sufficient. Okay.
is it?
So what I'm saying is, ma'am, for 2020, okay, let me put it this way. Every year you can write exams on all the months except in the month of March and April. Okay. And from May, when you start writing the exams, they will apply the tax rules of last year. That means May 2026, you're going to write the exam. Then they will take 2025 years rules. Then
Okay,
you have time till 2027 February to write the exams covering 2025 rules.
okay. So
So
now,
if you're having a textbook which says up to February 2026, another 15 days, if you're writing exam, then whatever contents I'm showing and all that is valid because they're covering up to 2024.
okay. So we'll be getting updated books in the month of May
You
then,
should,
sir.
you should, ma. Yes, ma. Yes.
Okay, sir.
There all the numbers will get updated, rules will get updated and all that. Okay.
Okay, sir.
Awesome. Okay, guys, I think that's all we have. We'll wind up now and we'll meet again tomorrow. Thank you, everybody. See you guys tomorrow at the same time, 6 o'clock in the evening. Bye-bye.
Thank you, sir.
Thank you, sir.
Thank you.